Welcome to Bar Charts Market on Close. I'm your host, John Rowland, Bar Charts Senior Market Strategist. Is there a difference between good buying versus bad buying as long as prices continue to go higher? Break out the hats and hooters when crypto comes home. Lay down the law and break it when crypto comes along. Have you heard of the expression salt of the earth? Well, natural gas salt might be your reward. Drones take off, and Uncle John heeds a warning in my fireside chat. All this plus your questions, and to help me out always is my co-host, Mr. X, Twitter Tom. Hello, Thomas.
Hello, John. How are you?
I am doing very well. I had a stock that we touted on our Wednesday webinar that popped over 10% today, so I'm feeling good about that. Hope some of our watchers got into that one.
Woohoo! Nice work, man. Nice work.
Yeah, thanks.
So we've got a jam-packed show, John. So we just want to give everybody a quick reminder. If you're watching directly on our website, you want to ask a question, just click Ask a Question at the top right. You'll see it highlighted in the orange color. And then if you're watching on our social media channels, just go ahead and ask those questions directly in the chat or the comments section, and we will get to as many as possible. All right, John. So last week, we mentioned that this week, the week we're currently in, is historically the best week of the year for the stock market. And true enough, it's played out that way, John. SPX hit an all-time high today. But what's really been catching my attention are these high-flying stocks, John, that just aren't showing any signs of slowing down. They just keep going and going like the Energizer Bunny. NVIDIA, Palantir, some quantum stocks, crypto, which we'll talk about a bit later. But, John, it's feeling to me like maybe a full risk-on moment. Do you see it that same way?
I certainly think that those stocks are continuing to high fly, and we'll look at them in a moment here. But let's just kind of review what we talked about last week, and that was the characteristics of the market in a post-V bottom. So let me do this. So here's our chart from last week. And again, what are some of those characteristics is that you get this slow, methodical rally, right? The market never convinces you to buy it. But also we looked at some interesting technical analysis. One was that we are now seeing the second negative divergence in the RSI. And I've told you that usually it's that second one that you got to be aware of. Now, if we look at this in terms of momentum, all right, this RSI, it's always important that we look at other time frames. And we can see that on the weekly, right, we still have nice positive momentum, and the RSI is not getting overbought, but, it is kind of flattening out. And then if we go to, let's say, a monthly chart, well, yeah, we're seeing smaller green candles, right, waning momentum, as you can see at the MACD, and maybe a beginning of another negative divergence in the monthly. So, Thomas, to me, you might have a lot of evidence that the market is high flying, but it really is kind of telling us that our momentum is really kind of waning here.
Well, it's interesting, John, because, a lot of the year we've talked about this idea that retail has continued to buy the dip, right? They've continued to add to their portfolios, whereas maybe hedge funds and fund managers were a bit behind the curve. And I wonder if maybe fund managers now, despite maybe some of the technical evidence that's saying momentum might be waning, I wonder if they're going to continue to boost the market higher, John, in an effort to sort of catch up. And what I'm talking about specifically is this chart, which is from Bank of America. And it points out, John, that fund managers, okay, have added risk over the last 3 months at the fastest pace in history, John, the fastest pace in history. And I wonder if that's going to continue, John, over the coming weeks and months, and maybe that will maybe offset some of that sort of waning momentum you see in the charts, John. What do you think?
Well, certainly, I mean, we're in the earnings season, and earnings could certainly be a catalyst to, taking the market to the next leg forward. But, let's think about this. We had Tom Lee on recently, and he said this is one of the most hated rallies, and he said that fund managers were behind in their allocations. In other words, they were underweighted the market. And if you are not allocating assets or capital to work, in other words, staying out of the market, and the market rises, retail buying, then you are net short the market. And so, from my experiences in price cycles, that you tend to see peaking in price cycles when you have a short cover rally. And so, what I'm saying to you is that I think a lot of this grind up is a bit of a short cover rally as these fund managers, and there's your evidence. You just told me that they're buying as much as they can over the last 3 months. Yet we're not, we're not spiking higher. We're not rip roaring higher. We're kind of just grinding the way up. And I'm going to give you some other evidence to my idea of this waning momentum. So, last week we looked at this chart, which was the number of stocks that are above or below the 50-day moving average. Or actually, we looked at this whole grid, and remember, we saw that this was basically all green. In other words, most of the stocks were above their moving averages in that 60 to 70% category. And we looked at materials, which was one of our strongest leadership categories, right? Remember, I showed you that of the 26 stocks that are in the materials sector, 100% of them were above the 50-day moving average. Now it's only 69% today. So that is, right, there's a little bit more red on the screen here. That is a sign that our breadth is narrowing. And then if we look at, again, here's more of a visualization of, here's the 5-day, 20-day, 50-day, 100, 200-day. There is this peaking, right? This peaking to the number of stocks that are above those moving averages. And again, here's one more piece of evidence for you. So here's our moving averages. And what I'm doing here now is I'm going to go by percentage above the 200-day moving average. Now, look, here are your high flyers that you just talked about: Palantir, Coinbase, right? G Veranova, which is that AI space, Tapestry, Coach Bags, Cruises. Notice that there's no Mag 7s in this top, tier of all these stocks. So you got to go all the way down here to NVIDIA, but NVIDIA is still above 30% above its 200-day moving average. So another sign of potential peaking is when you get above 25, 30% of your 200-day moving average. Doesn't mean that it's going to stop and turn around and crash and all that. It just means that you're probably getting closer to the top, and that the market could have a bit of a mean reversion. Now, it doesn't mean we're going to revert back to the mean of the 200-day, but we could revert back to the mean of, let's say, a shorter mean. In other words, our 50-day. And again, look at some of these high flyers, what percentage they are above their 50-day moving average. So let's go back to the S&P, and I'm going to add the 50-day moving average. And what do we notice? Well, our 50-day moving average here comes in around 6,000, which was a number that we struggled with for quite a long time to break through. And we created a gap at that point. And you know how I love gap fills. And so, I still think this is what the characteristics of a post V is, right? You break an all-time high, which we did. You set a new peak high. You come back and retest the old high, and then you move higher from there. And we're getting into that seasonality, right? Through July, we said that in August, you get a mixed bag. And then as we get into September, then you start getting some negative seasonality. So the market, to me, is still doing what we thought it might doing. Now, that, again, every time we try to tell the market what we want it to do, it, goes ahead and does something different. So I'm still going to hold that plan, Thomas. And I still think that is probably what we're seeing here. And, let's see what happens over the next couple of weeks.
All right. So let's talk about a subject near and dear to John's heart, and that is cryptocurrency. But in all honesty, guys, congratulations to all of you who have held your Bitcoin, your Ethereum, your altcoins that are flying. This is why we do it. Okay. Weeks like we've just saw. This is why we do it. This is why we deal with the doubters, right? Who tell us this is all junk. It's a Ponzi. It's a scam. Now we, the holders, are in pole position And the doubters are probably going to end up making a big mistake and chasing these coins at some point. But John, we're going to get to Ethereum in a little bit. I know there's some Ethereum fans. I'm an Ethereum fan. We're going to get to that in a little bit. With Bitcoin, I felt like it was coiling recently. I was impressed with the action, showed no weakness, just continuous buy pressure, record ETF inflows. I felt like it was setting up for a bullish move. I just didn't know exactly when it would come. But man, it came on fast and furious, much stronger than I expected, John. And I think that move was exacerbated by a huge short squeeze. Okay. So this is a visual. This is Binance. You can see people who have placed these huge bullish bets, John. I'm going to call them bets. These aren't even trades, guys. These are gambles, right? 50x leverage, John. 100x leverage, 25x leverage. You see the majority of these positions were bulked before the $122,000 price target, John. So now that we got above that, all of these shorts have been liquidated, and I feel like the bulk of that move has occurred. So now we're kind of chilling, right, John? We're kind of in this 116 to 122 range, just kind of hanging out for a while. John, where do you see Bitcoin now? Do you have any sort of thoughts on where you think it might go from here now that we just saw this huge explosion?
Well, let me just take a second. I noticed in here on our feed discussion on our bar chart feed, we're not doing a Bitcoin giveaway, are we?
No, unfortunately, we got some scammers on the Facebook, John.
Yeah, okay, there we go.
Junk.
Don't trust that Facebook. All right, so Thomas, let's take this from my point of view. Is you got a rally on a short cover squeeze. Again, to me, that is a sign of a peaking action for a price cycle. So here's my question back to you: is are you buying into this new all-time high?
I am not. I have my position is firmly established, and I am just going to watch it. I'm not adding.
So there's my point. Who's buying? Those who are short. The only people that I know that are buying is Michael Saylor, and I question, would Bitcoin even be at this level without Michael Saylor in the short covering rally? So again, I'm not poo-pooing the whole Bitcoin and crypto space. So certainly we got some interesting news this week, crypto week, and I know you're going to talk about how that's going to affect the market. But to me, this is just another sign of a potential peak in price or a price cycle peak, so to speak.
Yeah, I mean, I think I do think we are seeing the rise, right? We have Michael Saylor, he's the original, but we are seeing the rise of Bitcoin treasury plays, companies that are coming on. They are trying to pursue a Michael Saylor, MicroStrategy type strategy where they are going to continue to buy. They are going to continue to buy at these prices. So while I might not, they will. Michael Saylor will. Michael Saylor is on record as saying he likes to buy highs. That's his game. That's where he sees the strength. He wants to go with that momentum.
Right.
He's going to continue to add, and I think these other Bitcoin treasury plays will continue to do so.
So what's going on with this Genius Act and the Clarity Act? How is that going to affect the crypto ecosystem?
Yeah, so guys, we had I'm sure a lot of you have heard about this. We've got the Genius Act bill. This passed Congress. It was sent to Trump, who is certainly going to sign it if he hasn't already. This provides the regulatory framework for the legalization of stable coins. Okay. So we've talked about this before on past shows, John, stable coins, the advent of stable coins. Scott Bessent, the Treasury Secretary, believes it's going to be a positive for the US dollar. We're not going to get too much into that on this show, but I do believe stable coins are going to be a huge player in the future, John. Now, from an investing perspective, none of us here, John, are going to go out and buy stable coins, right? You're not going to go ape into stable coins. There's no money to be made on stable coins. They are just pegged to the dollar. But what you can do is look to see which crypto ecosystems these stable coins are being built on. So a major one, of course, is Ethereum, Solana, Ripple. And I'm saying Ripple, John, because I always get comments from angry people who say, hey, how come you didn't mention Ripple? Okay, guys, I mentioned Ripple. I'm not a Ripple guy, but congrats to those of you who are. John, this is going to be a huge thing going forward, and I think it's important to look at the rails and see which places these are going to be built on. Now, This is specific to Ethereum because I do want to cover this because we've talked about Ethereum before. We've talked about reasons that might cause Ethereum's price to surge. The Genius Act is certainly playing a huge role in that. I personally think Ethereum was due for a huge move regardless. But John, we also talked in the past about this idea of a rotation from Bitcoin to Ethereum. And that's kind of what we've seen, right? We saw that huge explosion
Right.
in Bitcoin. Then it kind of chilled out. Bitcoin is chilling right now, guys. And I think what we're seeing, John, is some people rotating some of those profits that they made it from Bitcoin into Ethereum because we are seeing a rocket ship of a move right here, John.
Yeah, but again, to counterpoint to you is, you have made this nice big move, but you are coming up against looks like some major resistance. Looks like 3 recent tops, and then you above that you can go higher. So I don't discount, right? But this could also be a little bit of buying the news, buying the rumor and selling the news too. Right now we've gotten that act, or if I don't know, I think it's halfway passed, or did it pass? I'm not 100% sure.
Yeah.
We're going to talk about the Clarity Act, which was another bill, and that also might open the avenue for retail investors into their 401k. So we'll talk about that. So listen, I'm happy for you, brother. I have a little bit of Bitcoin in, an ETF exposure, but for me, I still think this is kind of a price cycle, and I do feel that we're probably getting close to a peaking top right now, than something that is maybe more extraordinary, which would send us to all-time highs in the short run. That is, at least.
Yeah.
Okay.
Full disclosure, guys, Ethereum is my biggest crypto position. So just keep that in mind as I'm talking about this. I'm obviously going to be bullish on it. John, you make the point that it's coming up into resistance. I would actually take the counterpoint. I would say it has been knocking on the door of 4,000 about 3 times now. So the next one is going to be the 4th time. And I lean towards the idea that this will be the one where it breaks through that resistance level.
That old snowplow theory, right? The snowplow goes around, clears the way, and then like the second and third time, that's when you get that major breakthrough.
That's
all
my
right,
bet.
Thomas. Let's move on, though, if
Well,
you don't mind.
hold on, John. Hold on.
Okay.
And I just want to let you guys know I haven't sold a single coin in my so I'm not adding to my position, which was a question you asked me earlier, John. But I'm not going to sell, guys. I'm riding this out, and we'll revisit this in the coming weeks and months.
You're a hodler, right?
Diamond hands over here, John.
Okay, buddy.
All right. So now let's go to one of your topics, John, that you love to talk about. We actually get a lot of questions on it, and that is natural gas. John, you've been bullish on this before. Are you still bullish on it now?
Yeah, I think this is an article that came out this week on natural gas storage. And basically what this article says is that the expected demand from AIs and LNG production is going to overwhelm storage capabilities. And, if we look at the numbers behind it, AI centers right now it's about 4% of the U.S. energy production, the demand, and that it's now projected it's going to be about 12% by 2028. LNG production, which is about 13 BCFs a day, maybe a little bit higher, maybe about 15, is going to increase by 10 BCFs by the end of this decade. So demand for natural gas is continuing to rise. But we look at, let's say, production of natural gas has been rising on an average basis, year-to-year basis, is about 4.5%. But storage for natural gas is just a meager 0.1%. So what this article basically says is that the market is not anticipating this rise, and that there could be some short squeezes, so to speak. Again, a theme here in terms of inventory that could disrupt the market. And my belief, as my background is natural gas, I think we could see, natural gas prices in the next 3 to 5 years, we could see a double. We've been kind of hanging in that $3 to $4 range. I would not be surprised that the next trading range 3 to 5 years from now will be in the $6 to $8 level. Now, I wanted to talk about EQT, and this is a stock that has been part of my portfolio, and I know you teased about some unusual options activity. It's just quickly, the trade was somebody was bought the $58 calls, and this started last week. And then what they did was, here's our price history on that one. And let me just do this kind of quickly here. You can see that about Thursday, Friday, and Monday of last week, they started initiating a long position in the 58 calls. And then on Tuesday, just before this article came out, they sold $62 calls, so a $4 spread. Now you can see that they started out buying in the low teens and 20s. And, on Tuesday, those calls, those $58 calls got as high as $1.40. But if we go back to the $62 calls, well, they started out around 15-20 cents. And so this trader basically put on this $4 spread for about 15 to 25 cents. So really a good trade. Now, the reason why I'm pointing this out, and it's not necessarily an unusual options idea. It's just that I just want to show you that when you see unusual options, it's important for you to do this kind of background analysis to see what strikes are relative to the strike that is being traded, because this unusual option hit our screen on the 62 strike because there was no volume in it. But what you could have discerned is that this is what was some kind of a spread trade. And the other thing is that in EQT, again, full disclosure, this is part of my portfolio. This is basically just a little bit right of a utility. This is not a high flyer. This is not one of these sexy stocks. And we're starting to see a lot more activity like this in this space. So it's just another confirmation that institutional traders are starting thinking about this space. And again, we're starting to see a lot of price action based on this space.
So, John, we had a question on last week's show, and it was about an ETF. It was the ETF ITA, which was the U.S. Aerospace and Defense ETF, and I think that kind of triggered something in our brains, John, because we started to think about, okay, well, what could be some interesting investment ideas sort of within this defense industry. And I came across this headline, John, which is about our Defense Secretary Pete Hegseth making some moves, John, in an effort to unleash U.S. drone dominance, John. So now I think, our viewers might have some questions about, okay, well, are there actually drone stocks? Can we invest in specifically this area, John? Or what do you have for us on that?
Yeah, I do. So I have a watch list here. And what I'm going to do here is, just for those who are on our bar chart feed, I'm going to share that list with you, and you can get that list. But yeah, here's a lot of stocks. I did a little homework on you. I created this watch list. But here's kind of, again, let's look at this from an important performance basis, right? Here's a 3-month percentage performance. This article came out, I think, on Monday or Tuesday, right? So this is not a weekly phenomenon. This is not something that just is happening. The market, right? I mean, if we look at all the stocks in here, we really only have one stock that has not outperformed during this 3-month period. And so this is something the market is already well aware of, right? And again, full disclosure, a couple of months ago, a month ago or so, somebody was asking me, well, do I have any exposure in this space? And Red Cat is definitely one of the stocks that I do own exposure in. So I want to kind of just talk about this, look at some of these gains here. And I want to take this from the idea of a trader. And that is that, if you're going to be, in this case, Red Cat, my DCA, my dollar cost average is around $7. If you're in this stock or one of these stocks, and you've gotten 3, 4, 5 days, 10 days in a row where you've had a big movement in it, it's really behooves you to take to some kind of profit taking or some kind of risk management strategy, because you can see, look what's happening today, is how the market can quickly revert onto it. And so if you're not using this template on your days of action, so this is one of our bar chart templates here, and you can scroll down here. It's called the 13 EMA and pivots, and that's what this one is, and it's in the 30-minute time frame. And what is nice about it is it really helps you to help you time your trades on an intraday basis. And so what I got here was, market gapped up higher. It was looking really good today, but we fell back up to the pivot and then broke this moving average, or held right on this moving average. So what I did was I sold some covered calls against my position, and I sold some $16 covered calls. Now, why did I do $16? We'll go back and look at the chart, and you'll see that that would be near the all-time high. Now, I did August, which is about 20 days, 25 days out, and I did the 60. Now, look at our chart generator here, our covered call generator. So the $16 calls right now are trading 45 cents. I sold 75 cents. And that means that as long as Red Cat does not go above $16 between now and August, I'm going to make 4% return on my money. Now, that's 4% is based on this $11.45. But I did it when it was closer to $12, right, during that, right near that pivot. And that was about, so let me look at the numbers again, 6.2%. But remember, my dollar cost average is $7. Well, if I got 75 cents on a $7 stock, well, if I do this 10 months in a row or over a 10-month period, I'm now paid for that initial investment in that stock. And if I can get to that point, then I can just put that stock into my wealth basket. I don't have to worry about it because I already paid for it, right? I paid for it and I recouped on the income. And then what I could do is I could take that amount of money that I wanted to use in my trading plan. I use about 2% of my risk capital, and I could put that back to work. But maybe I wouldn't necessarily buy the stock. What I could do is I could sell some naked puts. And again, I would probably look at the chart and see if there were a value where I'd be willing to buy. But let's just say I had $10,000 that I wanted to reinvest. Well, if I shorted a $10 put, I could do 10 puts. Well, I look what I get here. I'm getting 80 cents. Again, if I can do this on a weekly basis or a monthly basis, that's income that I can start putting into my pocket. Now, if I get exercised at a $10 put on a stock that I really want to own, right? I already own it. I own it scot-free. Well, now I'm getting it at a discount. But if the stock goes up, then I'm getting paid to wait, right, for a buying opportunity. And then if I do get exercise on my puts, well, then I start selling covered calls. This strategy is called the wheel. And when you have a large gain and you can start making options trades where you put this in your portfolio at no risk, then the wheel becomes very, very, very lucrative. So keep that in mind. And, I'm going to continue to watch this stock.
John, I put out a tweet the other day, and I simply said, if you've ever wondered who runs the world, it is BlackRock. And this is why. They just became the first asset manager in the world, John, to be responsible for over $12 trillion. Now, it's funny, John, because a lot of people love to invest in BlackRock products. They make some fantastic products with a ton of liquidity. But on the other hand, a lot of people hate BlackRock, John, for what they stand for the wealth they've built up, just all the power that they have at their fingertips. Well, what do you think about BlackRock, John?
Well, first of all, I think it was $12.5 trillion. First of all, that's just a remarkable number, right? And it's not only just BlackRock, right? It's Vanguard and State Street. There's really the three of them. So I think this is very impressive, but it also, maybe there might be some worry about a concentration of wealth in just a few hands. That some folks have always said that. But there's something that's on the horizon that I think that we need to be aware of. And this is part of that Clarity Act, one of these bills that are up for vote this week. And that is that they want to open up private equity and private credit and private real estate to 401k customers. Now, allowing a retail investor to have access to those 401ks, I think this is a potential risk. Now, why do I say that? It's because I don't think retail traders understand the risks that are associated with private markets. So, first of all, this has been a secret for Wall Street for decades, and then typically they do have higher returns, but it is at an added risk. In other words, if you're in the private space, you can lose all of your investment. You're probably not going to lose all your money in an ETF. You could take a big loss, right? But that ETF is most likely not going to go to zero. The other is that the fees are a little bit higher, sometimes as much as 3 to 4 times higher than in the private market. And private markets tend to, not be marked to market. What does that mean? Well, it's very difficult for them to price them, unlike when we see mark to market in stocks, futures, and options. So we don't really know what the value of some of these private equity assets are. And the other thing is that they bar participants from redemption, sometimes for months, sometimes for years. So, they're saying that they're going to allow access to, have this ability to they're not going to put this time limit in or liquidate your position. But then you talk about illiquidity, right? How do you price something that, you don't really know what the fair value is? And so you might want to get out of one of these, and then there's an illiquidity, and you might be selling at a very, very large discount. So I think these are all risks that I think the retail trader does not understand. And, look at some of these large, the BlackRocks of the world. The Apollo Global is just hooked up with State Street, Blackstone with Vanguard. So to me, right, you're managing $12 trillion. Okay, so your management fee is what, 0.3%, 0.03%? Well, 0.03% on $12 trillion is still $36 billion in fees. Do you need to do this for a fee, to increase fees? Or the skeptic or the risk analysis trader in me says is, why now? Why are you opening these markets to me? What did I do to deserve this? And so you need to be a little bit skeptical about this. Are we being sucked into these markets because this is going to help these private equity markets get somebody to get them out of their position? So listen, I think as a trader, as an investor, you need to have options in terms of diversification, but I think there is a fiduciary duty of the Vanguard, State Streets, and BlackRocks of the world to have the least common denominator for trading vehicles that they are selling to retail traders. And I think that least common denominator has to be about experience. And I think to trade private equities, you need to have a lot of trading experience. That's not saying I'm saying you can't trade it. I'm just saying Uncle John's telling you here as buyer beware on that. Okay.
You know what's funny, John? This is a little follow up, and then we'll get to the Q&A. I saw this chart yesterday. This is from Bianco Research, and this chart is measuring retail performance against hedge funds. John, the higher it goes, the better retail is doing against hedge funds. So retail right now, John, is absolutely destroying hedge funds by the biggest margin since early 2024, John. So retail might tell you right now, John, hey, you know what? I think I know what I'm doing quite well, John.
Yeah, there you go.
Hedge funds shouldn't have access to some of these special products.
Well, that's also that fee story, right? Is maybe the hedge funds are struggling to make the fees that they normally did, or again, they might be laden with some bad trades, right? So again, this is more tongue in cheek, but I do believe that this is something that I don't think is right for the retail trader, allowing them to have access to private equities through their 401ks. So just, again, that's my own personal opinion and not necessarily the opinion of barchart.com.
All right, guys. So we got some questions coming in. Hey, guys, if you guys are watching on social, go ahead and leave a comment, like the video, share it with your friends if you could. John and I always greatly appreciate that. Let us know what you like about the show. If you have any questions there as well, just drop them there. So, John, we got a question sent to us via email ahead of time. And I actually thought it was a really good question because I've noticed this myself sometimes when looking at certain products. And the question is, they notice a big surge of trades that tend to happen right before the close of trading. And it's generally accompanied by very little change in price. So they're kind of wondering, John, you were a professional trader for 35 years. Do you have any idea behind the mechanics of what's going on here?
Yeah, I do. I have, and I think this is a very simple answer, but it's also a complex answer. So let's start this way. So there's an old adage that says that novices open the market and professionals close the market. So keep that in mind. Now I'm going to throw out a statistic for you. And that statistic, it says that 85% of the gains, I think it's actually higher than that, 85% of the gains in the S&P come from close to opening and not from opening to close. So if you're looking at a market that has a large spike in volume on the close, and then the next day you see the market, jump up or gap up, that's probably indicative of institutional accumulation. But on the headlines here, pull up my my screen, Thomas. The headline of a bar chart today, and you tweeted this out, right? That zero DT options now account for more than 60% of all the S&P options. Right there was that tweet that you said. And so I think there is a market mechanics that we need to understand is that a lot of this volume that you're seeing on the close could be related to this zero DT idea. In other words, market makers and speculators are unwinding their options positions as they get towards the end of the day. So let's look at today and see if we can get some kind of clearance or vision on this. And so here's a little feature that I don't know if a lot of you realize that we have, which is a graph volume. And so you can see that, look at all this volume that was traded in the SPY today on options that are going to literally expire today. Look at that volume. Now, what a market maker will do, let's say I'm a speculator and I buy an out-of-money call. Well, the market maker is going to buy the underlying to hedge that call. And then at the end of the day, what they're going to try to do is they're going to try to move the market away from that call, right? So that those calls expire worthless. So you can see there was a lot of volume, in the 628, 629, 630 level. So our market maker would probably was buying the S&P SPYs earlier in the day, but at the end of the day, they were going to drive the price down. Now notice where we are. We're just below 628. Now you got to look on the other side too and see where the put action is. And you can see that a lot of puts here around the 627. So this makes sense, right? Market maker is going to try to settle the market somewhere between 627 and 628 because they're going to try to make all of these options worthless. Well, that might mean that they're going to unwind these positions in the underlying. But also you could have an options trader who either exercise or is exiting a position, and that could create that spike in volume. And that's why you might see a spike in volume where you don't see the market move. So I think it's the two. So mostly day to day, probably zero DT, especially on the weekly and the monthly expirations. But if you see a large volume spike on a price movement, and the next day you do get a price movement, that's probably an indication of institutional traders. So I don't know. I think that answers the question.
Yeah, that was a good one, John. So John, you teased the stock at the beginning that did really well for you this week, and we got a viewer who wants to know what stock that actually was.
Yeah, this is EOS Energy. This is one of the things we talked about this week is mega trends in the market, and one of the mega trends is that in the renewable space, that the power of the our data centers is that what we're doing and what we're seeing is that the data centers are not going to rely on the grid. They're going to build their own power generation, and this is what is called behind the meter. but you can't have renewables, solar and wind, without batteries. And this company is in the battery space. It's a unique battery company idea. They're looking at zinc batteries and not lithium batteries. And you can go into our investment page under battery stocks, and there are many battery stocks in this space. But again, if we look at this from the performance basis, and again, let's look from year to date, because this is what we were kind of talking about, that my EOS finally started to make some moves. So I am trading around this one as well, and this is definitely a stock that I believe in. Again, this stock popped this morning, and I immediately sold calls against it. But I am basically trading around this position that I think I am, probably about $4 or $5 into options, some leap options on this one. Okay.
One of our longtime viewers, Ralph, who comes every week, John, he says that he wants to thank both of us for all we do for the investing public, and he says that the world is a better place for having us in it. So,
thank you. I appreciate that. I know Thomas and I, we work really hard on this show. I know it doesn't seem like sometimes we kind of fly by the seat of our pants, but it takes a lot of work and a lot of time. I don't know how these guys do it every day, though. But Thomas, I couldn't do it without you either. So
my mom tells me the same thing, John. So I'm glad there's at least 3 people out in the world who believe I'm doing something positive. So here's Ralph's question, John. He's an older person, and he has invested almost exclusively in CDs, certificates of deposit, and corporate bonds.
Right.
He wants to know if now might be the right time to expand into dividend-paying stocks.
Well, I'm not a financial advisor, and I don't want to go down that road. And I would say, Ralph, it depends on where you are in your life cycle. I'm guessing you, in your investment life cycle, you're at closer to the end. So, you might want to stick with what has been working with you. But I do like the idea of diversification, and there are many stocks out there, I think, that you could invest in that might have some capital appreciation, but offer a very good dividend return. Again, if you go on our investing page, we do have some of the best dividend stocks. So, Ralph, I know it's probably not the answer you want to hear, but I think if you do your due diligence, you can find some really nice stocks that have really nice dividends. Okay.
And Ralph, if you go to our YouTube channel, John, 3 years ago, you did a video called Finding the Best Dividend Stocks in a Down Market. Obviously, we're not in a down market, Ralph, but you might want to check out that video. Maybe there's a few tips in there for you that can help you sort of navigate that field.
See, Thomas, this is why I need you as my co-host.
Let's see. Okay, comment here. John, thank you for the excellent Explosive Trends webinar that you did this week. It was incredibly insightful and helped him confidently select a dozen ETFs. So bravo to you, John.
Oh, thank you. Well, again, that was those trends that we were looking at. And certainly in the energy space, I think I have a little bit more insight than maybe others. But yeah, I appreciate that.
Question here again from Ralph. Who is Ethereum competing with? And he says, is it large banks, ? I mean, I don't know that I wouldn't say Ethereum is necessarily competing against large banks. I think Ethereum's doing something completely different. I think they're just trying to open up sort of the world and, maybe democratize finance a little bit. Also, remember, Ethereum has been around a long time. So, a lot of people would say some of these up-and-comers like Solana and Ripple are actually trying to compete with Ethereum rather than Ethereum competing with them, because Ethereum had a huge first mover advantage. They've built a huge ecosystem. When you hear about these stable coins and these projects that keep coming up, a lot of them are being built on Ethereum. So that's kind of my take on it, where Ethereum is right now, John.
Well, I'm wondering if he's kind of asking, like, you get a lot of this noise out there that it's about how they're going to replace the financial system or the transactional financial system, and that these blockchain technologies are a lot faster and a lot more. What you've told me is the visibility on them. So it's I think is a way to improve that system, and
Yeah.
there's been a lot of fear about that too, right?
Well, now that the Genius Act has passed, I think you could absolutely make the argument that stable coins might be competing with large banks, and they're trying to open up sort of the US dollar and that system to the entire world. But I would say more so stable coins are competing rather than Ethereum. Ethereum is just an ecosystem. So the
Right,
stable
or
coins are more
not
about,
necessarily banks, but also credit cards too, right?
yeah, exactly.
Okay, all right, great question there.
Yeah, that was really good. John, we got a follow-up question. You talked about the wheel, and this person's wondering if you could sort of explain the wheel in a little bit more detail. They're wondering what that is.
Well, I think we do have a options webinar. I think either Gavin or might have done it, but basically the wheel is that you sell a put and a stock that you want to own, and then you hope that the market comes down and you get exercised on the put. So that gets you buy the stock at a discount, and then from that point, then you just sell covered calls out of the money, and then if the stock goes up and the call gets exercised, you're gonna make profit on the price appreciation plus the credit that you're going to take in, and then what you do is you go back in and you sell puts until you get exercise and you become long the underlying stock, and then you sell the calls, and then this kind of this wheel idea. Okay.
Yeah, if you go to our YouTube channel and you search for the wheel, you're going to find two videos, one by Gavin and one by Eric. So you should have a lot of material there to go through and help you sort of understand the wheel strategy. I've
been threatening to do one, but I think those guys in those short videos did a really good job explaining that.
Yeah. All right, question here, John. There's some talk about small nuclear reactors for data centers.
Mm-hmm.
Do you have any opinion on that?
Yeah, go and watch that webinar we did on Wednesday. We went, and this is one of my themes that we need to be aware of, and this idea of power generation behind the meter, or what we call microgrids. But under nuclear stocks, you can go in here and, again, from the performance basis, we'll look at this from a year to date. Lou makes enriched uranium. Elko makes recycles, but here's NuScale Power is in that space. GE Vernova is in that space. Rolls-Royce is in that space. And the other one is BWX Technology. So those would be in the small nuclear modular reactor space. But again, this is going to take a few years, and there's regulatory issues, right? But again, I was kind of teasing, imagine 10 years from now that every new home bought had its own little nuclear reactor built in the basement. Talk about unbelievable alpha, right?
Absolutely. We got a question from Dennis here about NNE, nano nuclear energy. That is not a stock I follow, John. I'm guessing I haven't heard you talk about that one either. Guys, for these small stocks that we haven't talked about, if you want, go to bar chart and check out the bar chart technical opinion, which will be listed. It kind of goes over all the technicals and gives you a summation of how that stock is looking on the charts. Dennis, you're going to be happy to hear this. Nano nuclear currently listed as a strong buy based on the technical indicators.
There you go. There you go. So if I don't know all of them in that space, that's the fault is on me. But again, you got to do your due diligence. One way to do it is, for instance, in this space here, we have nano nuclear. You could see alternative energy. This is the industry group that they're in. If you open that industry group up, and then you see who's in there, well, guess what? There you go. There's GE Vernova, there's Talon, there's all those companies I just mentioned to you. So you can do your due diligence that way as well.
And all right, so this is going to be our last question, John, and it's actually, unfortunately for you, one of your least favorite stocks, I think. And Tesla, they were wondering if you could do TA on Tesla, John.
Okay, I'm not a again, Tesla is going to be part of the battery thing, and there's a lot of new things that are coming out with Tesla. I just, there's other issues that I have with Tesla. Maybe I'm not going to go, I won't go into that. Okay. So, remember our strategy when we want to look at a particular stock, we want to do this kind of this top down in terms of time frame. analysis. So, let's kind of look at it on a weekly basis. So what do we see here, right? And again, I'm just looking at this, eyeballing this very quickly. What do we see? Well, what I see is a market that has just recently made a low and just recently made a high. And where are we? We're right in the middle, maybe towards the upper end of the high. Are we trending here? Probably, I would say probably not. We're probably in a sideways, or maybe even we could even argue that this is a distribution phase. Let's look at the daily again. What do we see? Maybe a little bit of a short-term rally here. Again, let's look how we are in terms of our moving averages, our 20, 50, 100, and 200 day. Well, what I see is we see a cluster of moving averages right in this area. A couple of them, the 50 and the 200 are kind of moving up, where the 20 has gone down. So again, we got, that's constructive. That's a little bit of support. Let's look at this from our MACD relative strength, kind of flat, right? MACD is starting to turn positive on the daily. RSI starting to turn positive. This is both signs that you might be seeing the beginning of an uptrend. And I'm just curious what we're seeing in the lower time frame. Again, going to use my pivots here. So, we have just bounced off, a level of resistance, and we are coming out of an overbought, again, a negative divergence. So a lot of mixed signals here. So a little bit of sideways and a little bit of uncertainty. Okay.
We actually got, I think it's too long now to do this one, John, but this was a good question from Vic, which is scalping versus swinging. And I'm wondering if we should tell Vic to come back next week, John, and you can prepare a solid answer on that one. What do you think?
Yeah, I mean, scalping is a very unique skill. And I will say this, if you're scalping, especially in the futures markets, I just want you to understand that the time frame that algorithms that are making the markets and that are trading, they work in the nanoseconds, and the human body can react in like maybe 16 100ths of a second or something like that. And if you look at that on a scale and you reverse that scale to a time frame that you're in, the algorithms are trading in 1 day and you're trading in 1 year. So, I used to be a scalper, but I wasn't fighting algorithms. It's a very difficult space to trade. And I'm going to leave it at that, Thomas. Okay.
Perfect, John. All right. Well, I think that wraps it up, John. Good job. That was a jam-packed one.
Whew. A lot. All right, folks. I appreciate it. If you're watching on one of our social medias, please give us a thumb up. Give us some little comments. Thomas and I, we really do appreciate you spending. You guys make this show, believe it or not. Until next time, the best of health, manage your risk, and the good of all trading.